Welcome to my latest research video presentation, in which I will be focusing on the US dollar, sterling, and to some extent, emerging market currencies. Let me first kick off with the US dollar. First of all, it's worth noting that the US dollar nominal effective exchange rate is at the top end of a 7-month range and is now only 0.1% below where it was trading at the end of 2015, according to my estimates. I'm maintaining my view that the dollar appreciation will extend to a third consecutive year, even if the gains that we are likely to see are going to be much smaller than they were in 2014 and 2015, and I'd refer you to the piece I wrote earlier this year on this very topic. My view that we will see a modest dollar rally between now and the end of the year, including versus sterling, is premised on a number of assumptions. Firstly, that Clinton will win the 8th of November US presidential elections, that US data and global numbers will be decent, and that in line with my long-standing expectation, the Federal Reserve will hike its policy rate 25 basis points at its 14th of December meeting. So what does this mean for other currencies? Well, under this scenario, I think that we would see very choppy emerging market currencies. But let's take a step back first. This summer, emerging market currencies had a strong performance led by a number of high-yielding commodity currencies, such as the Brazilian real and the Russian ruble. But as figure 2 shows, since August, emerging market currencies have lost ground versus the US dollar, and that's true whether we include the renminbi or not, and you can see that in figure 2. I think that under my current scenario, emerging market EM currencies from economies which are reliant on trade with the US, and that includes the Mexican peso and the Brazilian real, would likely benefit from a post-US election bounce if Hillary Clinton won the elections, given that her opponent, Donald Trump, is likely to opt for a less open US economy. But the looming Fed hike may ultimately cap any emerging market currency and equity gains. If the Fed indeed did hike in December, I would expect a number of things. Firstly, a broad-based dollar appreciation. Secondly, I'd expect other major central banks, including the ECB, to be more inclined to maintain their current monetary policy stance. Thirdly, in line with my view that we are at a very important inflection point for central banks, I think that policy rate cuts will be less frequent than they have in the past. I point you to figure 3, which shows how the major currencies have performed in recent months and recent years. And it's worth noting that the euro has actually been very stable. That's the green line, despite claims to the contrary. If we did indeed have a Clinton victory and a Fed hike in December, it's very possible that EM currencies and global equities would struggle to hold on to their post-election gains, whilst majors would underperform. I think it's important to note that the Fed would very likely want to avoid a repeat of the first quarter of this year, when global risk appetite collapsed after the first Fed hike in December. So where do we stand on the Fed? Well, we know for a fact that the Fed has cried wolf many times, preparing the market for a rate hike, only to then back down. Unsurprisingly, Fed fund futures have been volatile since the Fed's meeting in September, underpinned by US rates and FX markets, which have a tendency to look at US and global data events through dovish tinted spectacles. But pricing for a December hike has inched up in recent weeks to about 75%, that's about 19 bips, with seemingly little interference from FOMC members. And I think this has been due to a number of things. Firstly, we've seen a bounce in US macro numbers for the month of September, including PPI inflation, retail sales, ISM data, and some decent labour market numbers, which I'll come back to in a minute. Secondly, opinion polls indicate that Democratic presidential candidate Hillary Clinton has now built a greater lead versus Donald Trump. And then finally, we have seen a rise in international oil prices. Let's quickly turn to US labour market numbers, given the importance that the Fed and the market rightly attach to these data. Well, the September numbers were somewhat of a mixed bag. Non-farm payrolls in September were disappointing to some extent, and the unemployment rate did inch up, albeit very marginally, by 0.04 percentage points. But this really only gives us a very partial and potentially inaccurate picture of the US labour market. What I think is more important, and what I think the Fed actually focuses on, is the growth rate in private sector aggregate weekly payrolls. That number rebounded 4.3% year-on-year in September from a multi-year low of 3.5% in August. This index is important because it actually measures a number of things. Firstly, it measures how many people are working, and that was up nearly 2% year-on-year in September. How many hours they are working, and this was still down in year-on-year terms, and how much they get paid. And that growth rate is still reasonably steady, around 2.5, 2.6% year-on-year. Ultimately, this is a better gauge of the potential labor market-driven inflation we could see in the US. This number in itself, in my view, would shoehorn a December rate hike. But there is still slack in the US labor market, a point I've made a number of times this year. Firstly, the number of unemployed people, or those not in the labor force but wanting a job, jumped 345,000 in September. That was the fourth consecutive monthly increase. So whilst figure 4 shows that payrolls in aggregate terms have been rising faster, figure 5 shows that there is still slack in the US labor market. So there are some important caveats to my view of a December Fed hike. Clinton did have the upper hand in the first and second of the 3 scheduled presidential debates, and she's extended her lead in opinion polls, but she's fallen short of putting the election result beyond doubt, ahead of the third debate, which is due in a couple of days' time. I continue to argue that Clinton's victory in November is a necessary, if not sufficient, condition for the Fed to hike in December, even though Chairperson Yellen has rightly claimed that the Fed is apolitical. US data have in aggregate been decent, but I don't think they've dispelled concerns about the manufacturing sector. Ultimately, inflation and labor numbers will need to impress over the next few months. So let's turn our attention to sterling. Well, we all know the headlines. The sterling exchange rate has depreciated about 21% since November, and according to the Bank of England, recently touched an all-time low. Now, estimates of sterling fair value suggest that the currency is now undervalued and weaker than it needs to be in order for the UK to run a balanced current account, as it did in the mid-90s and briefly in the middle of 2011. So it's conceivable that sterling's collapse may attract FX inflows into the UK looking for cheap valuations and bargain hunting investors, which would in turn stabilize sterling or at least slow the pace of depreciation. But the risk of further sterling weakness in the next 3 to 6 months is still there due to the persistence of a large UK current account deficit and the withdrawal of foreign capital spooked by the government's stance on EU membership and the actual speed of sterling's collapse. Let's look at very briefly at the current account deficit. Well, the bottom line is it's probably not going to shrink very much near term. History suggests that currencies can remain undervalued for long periods of time if a country has experienced a severe shock. The trade deficit may not narrow or narrow only slowly and with a lag, and that's the case in the UK. Despite sterling's collapse by 22% since last November, the UK trade deficit has actually widened, not narrowed, to multi-year highs, and you can see that in figure 7. Moreover, and this is something that's not talked about that often, the widening in the UK primary account deficit is an even bigger problem than the trade deficit, accounting for 80% of the widening in the current account deficit since 2011. And you can see that very clearly in figure 8. So why is the UK trade deficit widening, not narrowing? Well, UK exporters and manufacturers are clearly hitting a number of constraints, and these constraints are not going to go away anytime soon. First of all, these exporters are facing weak global demand. Global GDP growth is sub 3%, and global trade has been slowing. Secondly, there is more to the competitiveness of UK exports than just price. Quality, after-sale service, and desirability are all part of the overall package. You only have to look at the surge in Korean exports in 2009, 2010, and the performance of German exports in recent years to show very clearly that what drives exports is not just price competitiveness, but a number of other variables. Furthermore, there are a number of factors that impact the competitiveness of exports. Not just sterling. Wages, productivity, and the cost of capital are all part of the mix. Furthermore, foreign exporters in the UK, and that includes a number of Japanese car manufacturers, have threatened to relocate abroad due to the UK's uncertain trading relationship with the EU going forward. And I think domestic companies will face a very similar challenge if access to the single market is restricted or becomes more expensive. Finally, it's worth noting that just because demand has increased doesn't mean exporters can expand capacity overnight. It takes exporters weeks, months, sometimes years to bring export capacity in line with demand. At the same time, import growth has accelerated, which highlights the UK's dependence on imports and its inability to substitute at short notice imported goods for domestically produced goods. And that, in turn, is putting pressure on domestic retailers' profit margins. Figure 9 shows very clearly this discrepancy between strong import growth and weaker export growth. As I've mentioned, the trade deficit is not just the only problem. It's been somewhat perverse, but FX capital inflows used to finance the current account deficit have themselves significantly contributed to the widening of the current account deficit. So to some extent, the solution has become part of the problem. What is the cause of this problem? Well, very simply, foreigners have increased their exposure to UK companies, equities and gilts. And that has resulted in large dividend and coupon payments to foreigners. These outflows have been much bigger than the corresponding earnings derived from the UK stock of assets held abroad. That gap's roughly 2% of GDP in 2015. You can see that in figure 10. And it's not obvious to me that lower outflows going forward will compensate for the wider trade deficit. So, until the UK addresses a structural deficit, and this could take months or years rather than weeks, it's all very much about capital inflows in the near term. And these inflows are currently in a negative feedback loop. Moreover, when the price of assets collapse, and this could be the price of currencies or gilts, buyers can perversely shun bargains. It's a somewhat different situation than if the currency is weakening slowly, giving investors time to re-ascertain their exposure. So the speed of the fall in sterling is a problem in itself. Sterling's depreciation has sparked fears of high import inflation, leading foreigners to downsize gilt holdings, sending yields higher and putting pressure on sterling. That's the vicious loop I referred to, and you can see it in figure 11. Furthermore, the UK economy's uncertain future may cap foreign direct investment inflows into the UK, while high yields could curb domestic borrowing, investment and spending. Finally, and I've already touched on this, until sterling stabilizes, foreigners may put on hold any purchases of other UK assets, and that could include things like housing. So what is going to drive domestic and foreign investors, including the world's largest sovereign wealth funds, to increase their exposure to UK assets and rebuild long sterling positions and ultimately short-circuit sterling's current downward path? Well, it's probably not going to be the Bank of England. There's probably little it can or should do near term. History suggests that intervening in the FX markets could actually make the problem worse by giving markets a target to aim at. Hiking the policy rate could in theory shore up sterling, but would dent the Bank of England's credibility, but given that it cut rates only 2 months ago. Conversely, cutting rates with the aim of depressing yields and supporting growth could actually speed up sterling's depreciation and spell of panic. Ultimately, it's the direction of UK government policy in coming months which is going to be the overriding driver of sterling yields and the economy. Well, so where does that leave us? Well, the ball is very firmly in Prime Minister Theresa May's camp. She's taken a hard-line stance on EU membership, and that has spooked markets. Her concessions to MPs so far are not impressed. She's going to have to convince markets that she can secure a better deal for the EU or show greater willingness to compromise with EU leaders if the UK is to maintain tariff-free access to the single market. I don't think either scenario is going to materialize anytime soon. For starters, the British government will not want to cave in so soon. After all, the Prime Minister's only been in power for 95 days. It's also conceivable that Theresa May will want to capitalize on the popular perception about the cost of excessive immigration by capturing traditional supporters of both the UKIP and Labour Party. However, there is still very much scope for debate and compromise between now and when Brexit is triggered, most likely by March 2017. And therefore there is scope for sterling to slowly recover next year. Hard Brexit is only one point on a wide spectrum of possible outcomes, with at one end the adoption of WTO rules and at the other unfettered access to the European single market. Moreover, Theresa May is not immune to popular, party, parliamentary and international pressure. The fact that she has started to blame the Bank of England for the UK's problem in sterling's collapse suggests to me that she's aware of her precarious stance. The rising cost of UK imports is going to be boosting the cost of living and eating into meagre real wage growth. And there are already signs that popular opinion is shifting against hard Brexit. Secondly, Theresa May will be weary of losing the support from within her own party, After all, the majority were in favour of remaining in the EU, or at least in favour of a more moderate form of Brexit. Thirdly, Parliament is already pushing against government taking full ownership of the Brexit process, and again, most of the MPs were in favour of Remain. Finally, key allies such as the US are already putting pressure on the UK to quickly find an acceptable compromise with the EU. From the EU's perspective, well, there is also room for compromise. The EU has a long history of dragging its feet on key issues before finding a fudge or a compromise. This time could be different, but I think it's too early to make that conclusion. I'd like to thank you for taking the time to listen to this presentation. As always, if you have further questions, please do not hesitate to contact me. I point you to my other pieces of research on FX markets and bring your attention finally to the disclaimer. Thanks again for your time today.